Hello everyone, welcome back to another video. Today we're joined by a special guest, Mr. Andrew Olson. Andrew, say hi to everyone.
Hello everyone.
Andrew is the newest associate at Conscious Wealth Investing. He hails from Kennesaw State. He is a former student managed investment fund alumni. It's actually where I met him. I went back to go work with the school. It's actually where I'm from as well and how I got started in the business. So Andrew, glad you're part of the team and thanks for joining us.
Yeah, happy to be here. Excited to talk today.
So it's going to feel a little bit different. We know that usually it's Brandon and I sitting here at a table, but Brandon is actually out earning or enjoying his earn, rest, and relaxation. So instead you have Andrew and I. Today's topic and the topic of really the month for our newsletter is valuation or value, right? And so value is a tricky topic because I think you have two types of value, right? You kind of have what are you willing to pay for something now? Think of like goods that you use every day. How much am I going to pay for a hamburger or some other household good versus what am I willing to pay for something that may be worth more in the future?
Yeah.
Right. So like, am I getting a good deal on this? Because one day it's going to be worth more, later on. And so the first thing we want to think about is expenses, right? And because I think that's kind of where people like intrinsically think of value all the time.
Yeah, absolutely.
You kind of live that life. And we were talking about this ahead of time. You had a pretty funny one from the COVID days, and that was toilet paper. And so I looked this up because I wanted to make sure that we were, doing our due diligence. There was a report by a consumer protection agency. I have it in front of you here. And the price of toilet paper went from the highest price on Amazon of $30.95 all the way up to $109 for a 36 pack of toilet paper in 1 year.
Yeah, it's ridiculous, and it's kind of a crazy thing to think about. But I really do think it's like just a great example of how sometimes there's a disconnection between like utility and value, and obviously toilet paper is super useful,
right?
But at the same time, there becomes this rolling phenomenon that happens across the market where everyone thought this was their last chance to buy toilet paper, which is that's crazy. But it's understandable. I mean, there were obvious externalities. Pandemic makes people think irrationally, but this is totally something that happens in our brains. Every once in a while, something comes along that just breaks our valuation system, which is like you're saying about everyday expenses and stuff is always operating in the background of our brain. And something comes along and it just absolutely turns it upside down. And all of a sudden, your spare bedroom is full of toilet paper.
Right. Or your neighbor down the street, the cops are coming because he hoarded all of it from all the stores around, right? That happened as well.
Yeah, exactly. And you're having your toilet paper repossessed and you think, what's going on in my neighborhood,
Right.
But yeah, sometimes we just get a huge disconnect between the actual value of something and what we perceive it to be right now.
Yeah, definitely. And I think where we hear it a lot is people in financial services is something over or undervalued, right? And that's kind of a strange question because there's obviously a hugely technical advanced way to model out companies. There's a variety of different ways. There's certifications you can get. You can go to school for it. Like it's a serious topic, but there's also like FOMO, right? There's the fear of missing out where sometimes the market or small individuals identify an opportunity. It goes wildly up in value. And because that generates clicks, everyone knows about it. And it's kind of a self-reinforcing prophecy. So I want to show you a clip of when this can get really off the rails. This is from 2021. If people don't know, 2021, small cap tech just went completely crazy. Yeah. Every little company was getting an opportunity. Coming out of COVID with all this money and everyone working from home, it was kind of a mess. And so this was, I think, the natural outcrop of that.
Putting money in right now include Upstart. That is one.
So, Upstart's up about 25% just in 4 days. That's a good looking name. Very powerful, very strong earnings. These stocks are.
What do they do? I don't even know them. What do they do?
Excuse me.
What does Upstart do?
I'm sorry.
What kind of company is it?
Yeah, I'm not. You're breaking up.
So he wasn't breaking up. He did not know what Upstart does. For those who are curious, Upstart is actually a company that uses an algorithm. They say now it's AI because of rebranding purposes, but they basically use technology and algorithm to try to have better loans So they're a consumer loan company. They give people money and they try to do it very efficiently with technology, right? So they're just very modern bank, essentially. One thing you may have noticed on there was it was up 800% year to date, right? And when something is up 8x in 1 year, someone is going to end up on TV to talk about it.
Yeah.
The problem is if you're participating in FOMO, you're not actually an investor. You're just trying to like be involved, ride a wave. You could be left not knowing what happened to that company. And if we were to go on their investor relations page, let's see, I can find this stock chart. If I go out all the way max, you can see that at the height was really, I think, when this guy got on TV. And after that, it almost set off a wave of, some like a reckoning in the small cap tech market. And you can see the stocks never really recovered from that high.
Right. And it's exactly what we were just talking about, where the same thing happened again with toilet paper. I mean, at some point, someone asked the question, is this really gone forever?
Yeah.
And then a bunch of people started thinking, oh, wait, no, things are going to come back to normal. And this guy just kind of highlighted, he didn't have an answer for what did they do. So people looked into what they did. And then they thought, okay, this is a cool company. I don't know that it's worth hundreds of times or whatever the multiple was.
Right. And so, obviously FOMO can affect all of us and none of us are really safe from it. I don't really want to put it that way of like, oh, you shouldn't worry about missing out, because it's a very natural human emotion. If we were to look at really getting back to the question of, what are you willing to pay for something? The classic question I think every person in financial services gets asked, and that we just have questions with your friends when you see the stock market where it is, did I miss out?
Yeah.
And did you miss out on what, right? Because you think that like the S&P 500, which we talk about all the time, it's 500 companies. There are millions of people who work at those 500 companies.
Yeah.
They all go to work every day. They try to generate revenue. These companies are trying to go up and to the right on a chart. They're trying to get bigger, get more market share, be more efficient. So when you have that, I don't think anyone's missing out on thinking about, oh, am I missing out on the stock market never growing again?
Yeah.
Because like it goes up and it goes down, but over the long term, it's almost always grown, right? As businesses existed. The question is, am I paying too much for it right now?
Right.
Am I buying it at a good time, or is now a later time? And so one of the ways to look at that, and there's many, is what's the long-term price to earnings ratio? So for every dollar you put into a company, how much earnings are you getting out of that? So, a natural way to look at it would be, what's the long-term PE ratio of the S&P 500? Well, if we look at this 20-year chart, we're on a company called, or a platform called Koifin. You can see at the average price to earnings ratio for the S&P 500, it's a 20-year chart, is about 22 times earnings. So typically it costs $22 in the stock price to get $1 of earnings out of those companies.
Right.
And you can see that that's the long-term average. And lately it's actually trickled up, right? Yeah. It's actually gone up to about 28.5. And we're getting to really like one standard deviation outside the norm.
Yeah.
We're getting up above that. But you can see over the long term, I think if we were all to back up for a second, the worst time it's ever been, out of whack was actually when the market was at its lowest.
Yeah.
Right. So there was an overselling event where people sold so much and companies lost so much money. There's just massive disconnection. Right. So 2008 all the way into 2010, when things started to recover, we really didn't, the average standard deviations, none of that mattered. Right. It all kind of got thrown out the window. If we come back down to earth, it's 2010, things are settling in, we're back to the average. You can see there's a very, very long period where the market did very well, where we really just tread around the mean.
Yeah.
Because ultimately, as companies get bigger, we can always look back and say, oh, well, 10 years ago, the mean was actually only 16 on the price to earnings. Well, yeah, but 10 years ago, companies were smaller.
Yep.
Right? Or maybe certain companies in the industry that made less money, they were a smaller component. So we saw an article recently where 55% of the S&P, 5% of the S&P was technology in like 1992. Yeah. And now it's 30%, right? And these are like completely different companies than like a gold company or like a General Electric versus a Microsoft.
Yeah.
Two very different stories. So sometimes the market shifts, and so our valuation assumptions have to shift as well. Right. And I'll hand this one off to you. If we were to look at the technology sector, you can see that the valuation's actually higher, right? So not only is the average higher, even going out like a standard deviation or what people are paying now, all of that's higher too. Why could that be?
I think that the primary reason is because I think people associate tech with innovation incorrectly, because a lot of all of the innovation pretty much in my lifetime has come from the technology sector. And for a long time, it's been driven by that innovation. And when you think that there's a tail risk that things are going to go really, really well, which happens sometimes, then you're willing to pay a premium for it. I mean, it's just like anything else. If there's a service that has an extra level of, maybe upside, then you're going to be willing to, put a little bit more at risk to get that. And it's going to be a little bit more expensive, especially when it's in super high demand, which technology is both in our hands, in our, everyday lives, but also, in the broader stock market.
Yeah, definitely. I think there's also an internal reason in these companies too, which is just margins.
Yeah.
Right. These are wildly profitable companies. If we think about every time we build a cell phone, right, there's a fixed cost that goes into that. There's a distribution chain that has to be paid for. There's people at a store that have to be there to sell it to you, right? But if you're Microsoft and you have Outlook or Microsoft Office, all you have to do is log on the internet.
Yeah.
Type it in and boom, it's downloaded.
Yeah.
So it's providing value instantly, and you're really just paying off the upfront cost of development and then the maintenance.
Yeah, absolutely. And I mean, that's the difference in the leverage factor of manufacturing versus technology. You look at technology companies, they don't have a ton of debt. They have a ton of cash on their balance sheet, and also they generate a ton of free cash flow.
Right.
And so you just see like a greater opportunity for them to invest in their own margins, and their margins are very good.
Yeah, absolutely. And ultimately, like you said about innovation, how much did the first cell phone cost?
So we were just looking at this. The first cell phone cost in 1984. This is the Gordon Gekko Motorola cell phone on the beach. Motorola cell phone. This cost $3,994, which in today's dollars is almost 12 grand. So that's how much a cell phone was when it first hit the market.
Right.
Now, obviously, very few people could get that cell phone.
Could you play Candy Crush on the cell phone?
You could not play Candy Crush.
Right. Which is what is the point of this phone? To call people?
So it's at least $11,000 overpriced.
Yes. Absolutely.
Yeah.
So when we look back at that and we think about what could happen in our future, no one really knows. But right now there is a wave going on towards something referred to as AI. And AI, now it's what's the joke? It's like gluten. It could be anything.
Yeah.
Right. But AI really is an efficiency in the technology space that people think could really make a difference in the market. And what we're starting to see is, okay, if this new thing is coming out, is this the next cell phone?
Yeah.
Right. So if it is, well, guess what? Whoever's making $12,000 adjusted cell phones, they're going to make a killing for a while. Yeah. And eventually it'll come down, but they'll be first to market. They'll have a first mover advantage.
Right.
And then slowly we could see the rest of the tech sector, or even companies that embrace this technology be more efficient, we could see them turning it from a product into a service.
Yeah.
Which is really where you make all your money, right? Is going from physical goods to how do we create services, experiences off of that. The leader in that space right now has been NVIDIA, right? That's everyone's heard of it. If you haven't, NVIDIA is a large semiconductor company. They make computer chips. Right now they make the most advanced computer chip specifically for AI. They have several competitors, but they're pretty ahead of it. And if you look at their financials, I mean, they're making money hand over fist, to say that politely. Year to date, the stock is up 147%. It's now, I believe, 6% of the S&P 500. Yep. So there's 500 companies. 3 of them now make up about 12%. NVIDIA is one of them. If you were to look at the 15% year to date return of the S&P, 5% of that's just from one company, which is NVIDIA, right? Which is crazy.
Yeah.
And, we say it's crazy. I mean, maybe it's justified, right? That's the question that we're getting to. That's kind of the valuation question. I think to kind of hit this home is to look at NVIDIA versus Microsoft. I think Microsoft is the classic tech company. Everyone's familiar with it. It has infiltrated all of our lives. If you work in a business, in a school, if you just have some kind of communication device, it's probably running a Microsoft product on it. So 20 years ago, right, this is a 20-year chart, NVIDIA was worth $3 billion. That was its market cap. Its price times available shares. Microsoft 20 years ago was worth $300 billion.
Yeah.
So we have like 150 billion or 150 times multiple difference, right? Well, when we see the recent uptick, 140%, 1,000%, whatever percentage basis you want to go on, essentially what we're seeing is NVIDIA over time, they kept improving their products, they had more market penetration, and while people kind of knew and understood what Microsoft was doing, the rest of the market was catching up to what NVIDIA was doing. Right. And as the devices we have, cell phones, big data centers, AI-powered chips were being developed. We have spaceships that can land themselves now. As all that new technology came about, NVIDIA really was kind of there silently picking up some steam.
That's
right. And you can see they get pretty close, right? So we have a difference of, in actual terms, $700 billion in 2018. Well, that's significantly different than 150 times difference in size, right? And so then in the last year, really, where we've heard AI become the new hot topic, you can see that they've really closed the gap. And so now the question, and it's a multi-trillion-dollar question, is NVIDIA fairly valued? Is there still a bunch of room to run? And then if they're fairly valued and they're doing all the inputs, they're kind of building the infrastructure for this, how much opportunity is there then for other companies to use their products, turn it into something that all of us can use as consumers and then make money on it?
Right.
And it's exciting because it's like, okay, we have this thing, someone's making a lot of money, maybe it'll make even more money and we could be part of that. And then what are the other opportunities? Because there's got to be something next, right?
Right.
When the gold rush happened, there were the picks and shovels. That's actually where that term comes from. But someone still mined gold, right? And then that gold went into the market and it created jewelry and it created all kinds of things. So there is an after NVIDIA pop in this. We just may not know what it looks like yet. We don't know when it's going to happen.
Yeah, absolutely.
So now we've looked at, value of toilet paper, taking that all the way to the natural conclusion, which is big tech companies' valuations. How do we wrap this up? I think the idea is something we talk about all the time, and it's kind of the boring answer, but it's the real one, which is if you stay diversified, you stay invested, you can be part of all of these advancements in technology. Right. So if you want to buy NVIDIA, you can buy NVIDIA. If you want to buy the S&P 500, good news, it's 6% NVIDIA. And all the other companies that are contributing to the economy being part of this change, you can be part of that.
Broad exposure makes sure that you don't bet the farm. You're not going to lose everything, betting all in one direction.
Right, because we don't know. This could be a 5-year thing, right? When we talked about things like nuclear fusion, we thought we would have that 50 years ago. It's always another 10. So, maybe it's here to stay and it's just around the corner. Maybe we're a couple years out. But if you've been part of it, that is amazing. And that's been incredible for your portfolio. And if you're just getting into it and you're wondering, how do I be a part of it? The simplest way is just broad-based diversification by a lot of different companies, and just don't take too large of a bet because you never really know who can be the next leader in this space.
Yeah, absolutely. Your iPhone is not made by Motorola.
No.
Sorry for the spoiler alert.
It is not.
But
no, I think that's a great place to end on. So Andrew, thank you for joining me today.
Yeah, thanks
for having me. Hope this was informative. If you have any questions, obviously reach out to us. We're happy to answer. And y'all have a great rest of your day.